Thanks for tuning in to this episode of the Live at Lunch series on the Resilient Advisor Show. My name is Jay Coulter, and joining me for this episode is Clint Sorenson, the CIO of Wellshield. Now, don't act like you're not impressed with my fancy intro videos.
I'm very impressed. And I also enjoy the Anchorman reference in that quote there.
Yeah, I got to tell you. So for folks that have just started watching the show recently, Clint's been coming on for a couple of years now, maybe going on 3. So he struggled through when we were just a podcast and I barely knew what I was doing to now where we have fancy graphics, we've got videos, and you're still coming on, Clint. I really do appreciate it. Today, we're going to talk about the WealthShield Trend Report. We try to do this on a regular basis. The team at WealthShield puts out great research on trend following and the applications for financial advisors. Your time is valuable. Here's what you're going to learn today. WealthShield's thoughts on the trends that they saw materializing in the markets last month. We're going to talk for a minute about Bitcoin, and then Clint and I are going to have a discussion about a 200-day moving average versus a 10-month moving average, a discussion that we've seen be pretty popular on Twitter here recently. So let's start with this. I have started a series on Bitcoin. Clint, I'm a Bitcoin skeptic. I know that you are not. I have got a great lineup of thought leaders coming on to talk about what they think is important for financial advisors to know about cryptocurrencies and the blockchain. So Tyrone Ross came on last week. He was my first guest. He's going to do a regular series we're going to call Office Hours with Tyrone Ross, where he's going to answer questions advisors might have on it. Here's what he had to say when I asked him the question, why should advisors even care about the space?
Well, first of all, I think it's really important to focus on one keyword that you said, and it's fiduciary. So I don't care whether you are a crypto skeptic like yourself or crypto hectic like myself. As a fiduciary, you have a responsibility to be knowledgeable on things that your clients ask about.
Good answer. What's your take?
Yeah, I mean, look, I think every asset will be digitized. I remember you and I having this conversation maybe a year or so ago. And I still believe that. I think every asset will be digitized. I think what we're witnessing from a blockchain perspective is, in fact, a revolution, just like the Industrial Revolution or even the revolution of computing power. I think this is another one of those. I think every asset will be digitized. I think Bitcoin is an expression of that digitization as it relates to money. And I think you're seeing it rise in popularity. You're seeing it rise in use case. And I think that's only going to continue to expand. And I don't think it's just Bitcoin. I think it's smart contracts. It's the Ether. It's the new internet, if you will. When you consider all the apps that are being built on that infrastructure, I think it's way deeper and way bigger than just Bitcoin. But I absolutely think advisors should understand this area, should understand how to invest in this area, how to position size in this area, how to take advantage of the technology. And I even think wealth management firms should tokenize themselves. I think ultimately, I would not be surprised to see, instead of offering equity to advisors, for a lot of these aggregator firms to begin to tokenize and offer up either security or utility tokens for their firm. I mean, I think it's going to expand exponentially from here.
If you're watching this broadcast live on LinkedIn, Twitter, YouTube, or Facebook, please ask questions. It's really simple. Go into the comment section, type your question. The system will send it through to me, and I'll pose it to Clint. Before we get to the trend report, I'd love to get your thoughts on the 200-day simple moving average versus the 10-month simple moving average. And I'm not asking for you to pick one. Just contrast the two for us and through the lens of a financial advisor and why they should even care.
Yeah. So, I mean, I love them both, right? Because they're, no pun intended, they're simple, right? To apply, to execute. Goes back to Occam's razor, right? You want to keep things as simple as possible. And I think that aids with execution. Now, I prefer the 10-month over the 200-day. And that's just due to, I think, behavioral considerations, the ability for an advisor to execute. And again, that's the lens I'm looking at it through is, could an advisor that we service execute on the discipline? And I think on a 200-day, you get a higher frequency of whipsaws, a higher number of trades historically. And I think that can be challenging when you get false signals. The more false signals you get, that increases the difficulty in sticking to the process. And I think it goes back to what you and I've talked about before. The ability to stick to a process is more important than the process itself. And so, I like the 10-month for that reason. Following it once a month, looking at where it closes relative to that as your signal line and executing according to that has proven historically, if you look at a back test or look at Meb Faber's work, or other work on just the 200-day itself using a monthly close, it has worked phenomenally well to lower and reduce drawdown and risk while keeping returns about the same as if you bought and held. So better behavioral experience and frankly, in my opinion, a better or an easier execution when it comes to actually applying the discipline.
Yeah, and execution is always the biggest challenge. The fact if you use the 10-month simple moving average, there's only 12 trading days in the year for you executing on that. And like you mentioned, from a behavioral standpoint, that's going to make all the difference in the world.
All the difference, because if you can't execute on the strategy is useless. I think it was Richard Dennis who said, the famous, founder of the Turtles, if you will. He said he could publish his rules on a billboard, no one would follow him. And I agree with that. I think at the end of the day, it's the discipline to stick to a process is so important, and the simpler, the better.
That's right. That's right. All right. For a programming note, on Monday, we're going to have Kevin Simpson from Capital Wealth Planning. He's going to come on to discuss covered call strategies and how you can leverage products that are in the marketplace to capitalize on that space. That'll be this Monday at noon. Kevin Simpson with Capital Wealth Planning. I'm really looking forward to that conversation. So, Clint, you got to admit that was fancy too.
That was. It's pretty incredible, man. All the bells and whistles you've added to this thing.
Oh, man. All right. So let's get to my favorite part of this, the trend report.
Yep.
So here's why I look at the Wellshield Trend Report. They have broken down their view of the marketplace into a framework that has 4 components that I believe an advisor can understand and articulate to their clients. Clint, I'm going to pull it up on the screen and I'm going to let you walk through it.
Yeah, absolutely. So I'll start first with market valuations, which is the third one down. And the reason I start there is because that's kind of the long-term, call it strategic view or mean reverting view, right? The idea of valuations, you buy low, you sell high. It's really easy for a client to understand that. We then go into what we call our growth, inflation, and policy models. That's 2 components. That's economic growth at the bottom, and that's monetary policy, which is the second one. And then that really covers a 2 to 8 year time frame. So think about the typical business cycle. That's what that really is governing, or what we're trying to measure there. And then the last one is market sentiment, which is really just trend. It's trend following, it's 200-day moving average, mentality, right? We're wanting to buy what's going up, stay with strength, sell what's weak. So really simple, but again, trend following and momentum work really well over that 0 to call it 2 year time frame, but really peak at about 12 months. And so that's really our short-term view. So the framework was designed to diversify by time period, diversify by discipline, and also to be simple enough for us to execute on. So it doesn't require prediction, right? I mean, all of these things is just measuring and observing data. And then from that data, you say, hey, what's the highest probability decision I can make from a portfolio perspective to help a client reach their financial goal, help an advisor execute on a discipline, et cetera. So when you look at where we are today, market valuations extremely stretched. I mean, it's obvious there, right? Market cap to GDP, which is the Buffett indicator, just reached the highest ever. If you look at a lot of Dr. John Hussman's work, which I use a lot in our trend reports, and I am so thankful for what he has provided to the industry from a valuation perspective, because he does some incredible work. You can see that expected returns are really low, right? And that's what it tells you. It says on average over the next 7 to 15 years, my returns are going to be pretty low if I bought and held the S&P today. So when we look at market valuations, we're really looking at global market valuations. We're pretty high. If you look and strip out the U.S., valuations are a lot more attractive. So there are pockets of opportunity and pockets of undervalued conditions, but they just don't exist in the U.S. From a economic growth perspective, we're improving and we're moving towards that acceleration, which would be a recovery. So leading economic indicators, if you look at things like the ECRI, Economic Cycle Research Institute's weekly leading index series, it's year-over-year positive now, up over 1% year-over-year. That's a great sign. 4-week moving average is still negative of that, but we've seen improvements, and now we're starting to see some accelerations. And so just by the nature of math, we can expect a recovery, right, below trend, but accelerating growth by, at least the second quarter at the latest next year. And so that's really important. And then monetary policy has just been incredible. I mean, the Federal Reserve is the 9th largest holder of the Apple 2023 bond. It's the 3rd largest holder of the LQD iShares ETF, corporate bond ETF. We've pumped in trillions. They partner with the Treasury to create a special purpose vehicle so they can expand the range of assets they buy. They're buying junk bond ETFs, corporate bond ETFs, treasuries. They own 1/3 of all mortgages. It is incredible. So it's as bullish as you could possibly be. And then that spills over and helps out market trends. It's with money supply growth at up 23% year over year. You've seen market trends really explode to the upside as seen in the rally since March. So that's really what we're witnessing. Market trends are positive. Monetary policy is positive. Economic growth improving. But market valuations are extremely negative for long-term returns. So it's really a mixed bag when you look at our framework. And what that tells us, how do I apply that? What it says is diversify your portfolio by system, by discipline, go to the areas that are strategic opportunities, so meaning they're undervalued or they offer some relative value. Be prepared for a recovery in those recovery trades. So make sure you have at least signals in place or systems in place where you can allocate to the areas that work really well in a recovery, like small caps and value, and have a good chunk of risk management in the portfolio due to where valuations are, especially in the U.S.
All right. Whenever I get this report, Clint, one of the first pages I flip to is the market sentiment page breakdown. Your team does a great job with this because, in my opinion, it really helps segment between 3-month, 6-month, and 12-month. There's a whole lot of green on this page. Yeah. You're a financial advisor. You're building portfolios. Maybe you weren't quite as optimistic as the markets were as you added new money or took on new clients in the past 6 months. What do you do with this data?
Yeah, so the way we apply this data is we always want to have a good portion of the portfolio. So it ranges depending on the risk tolerance and behavior of the client, because those two intersect to kind of help us guide how much we put in the tactical approach. But we want some portion, 10 to 40%, right, in that range, in trend following strategies. And what this tells us is that the trends are positive, and the trends have been moving positive. So, U.S. stocks, if you look at the NASDAQ, for instance, been in a positive trend for a while. Tech, from a sector perspective, been in a positive trend. Communications, retail, been in a positive trend for a while. International equities, not so much, kind of a mixed bag. High yield bonds over the short run, we're moving into a positive trend recently, but just lately have moved back into neutral on the 6-month and 12-month. So we always recommend having a portion of a portfolio that is tied to just simply following the trend of the marketplace, because we never know how long that trend will last. And we know that if we can capture the bulk of a trend, then we can, do pretty well long term. We can increase our compounding rate and protect against risk. So that's how I use this data. 3-month, some systems are run on the 3-month. That helps us understand short-term trends. What are they doing? They've been positive for a while now. That was the first thing that moved positive, obviously. Intermediate term trends, they moved into neutral, some still negative, but with the drop in risk-free asset returns, you've seen those move positive. Because you got to remember, to move neutral on our dashboard, you just have to have positive total returns over those reference time periods. To move positive, you have to have positive returns over the risk-free asset. That's how we're measuring trend, because it's not so myopically saying I have to always have marketitis or tickeritis and move into the market itself, the S&P or the Russell 3000 as we measure U.S. stocks, or the the FTSE All World ex-US for international or high yield bonds, right? It's all about where is the optimal place for my capital. And so we use this dashboard to understand, okay, yeah, they're trending positive on the absolute basis. So it's not going to be negative, but it may not be positive. It may be better to have your money in this, if over the course of these time periods, in something like the risk-free asset. And so that's what this helps us measure, is where's the best place for your money. And what we want to see is for each of these things, international stocks, US stocks, high yield bonds, we want to see at least 2 out of the 3 time periods positive. That's what we're looking for. That's a good environment. And so that helps us a lot with trying to determine, should we be allocating to this over risk-free? Should we be allocating to this over cash?
Yep. So Clint, we have a question from a viewer. It's Michael Kreimer. I know he's with AssetWise over in Charlotte, North Carolina. He asks, in terms of when to take action, which trend carries the most weight, 3, 6, or 9 month?
So we use 3, 6, and 12 month, and we equal weight them. So they're equally weighted in terms of our dashboard. Now, it depends on the system you're invested in too. So we've built several different systems. For instance, in our dynamic fixed income strategies, where we have built several indexes that track rotating between high yield bonds, treasuries, and cash. So very similar to this dashboard, we track short-term movements there. So that's going to be your 1 to 3 month. On when we're looking at equities, we're typically in that 6 to 12 months. So any momentum index we've built in the past is typically a 6 to 12 month. Sometimes equal weighted in both time periods, sometimes just 6 month if we're dealing with sectors, things like that. But we're essentially just trying to have a robust process, not really optimizing per the time period what's best. Again, the key is just making sure that if we change those parameters, right, if we go from 1 month to 2 months, it doesn't completely destroy the system. That's really what we're after. We just want something that's robust that we can follow with discipline, not so much worried about optimizing whether we use 9 months, 6 months, 3 months, whatever. So, but we have figured out that in fixed income, we like shorter term time periods and changes. So in all those indexes we've built, we've typically built those on 3 months or less in terms of measuring the time period. And we have weekly systems and monthly systems we run there. That means how frequent we're observing the data. And then on the equities, it's typically 6 months or 12 months.
Excellent. Thank you for that question, Michael. Again, viewers, if you have a question during the broadcast, simply type it in the comment section on the social media platform that you're watching this on, and we can pose the questions to our guest. Clint, once I get your report, after I look at the market sentiment page, I like to go to the back to see what you're thinking longer term.
Right. Yeah, so, this is my favorite piece. Yeah. Yeah, so and you can see, Jay, we changed it actually to make it a little easier, right? Well, we call this our playbook. So we always believe, and if in our first effort to write a book, right? We wrote a book called Invest to Prosper, and this is back in like 2015, and we talked about pairing value and momentum. And Alpha Architect, they do a great job talking value and momentum, Faber, value and momentum. We're not the only people out there talking about using value and momentum in a combined fashion. And so that's what we're really looking at here. Our long-term playbook, our strategic playbook, is really driven off those value opportunities. Relative value in this instance is kind of how I'm displaying it, but it's really where is the highest expected return? Where is their blood in the streets, right? Where is their fear? And we want to try to capitalize on building our list there. So when we talk about our playbook from a long-term perspective, that's value-driven. Then we have a tactical playbook. And if you balance those out properly, you end up having a pretty good approach. And our tactical playbook is really about what's strong and what's weak. Go to what's strong, avoid what's weak. So very simple in terms of how we apply it. So if you look at where we see the opportunities, and I can go through scenarios that really excite me about the long-term opportunities, our view that it's not going to be large U.S. growth. Tactically, that's what's strong, right? But that's not necessarily where we see the long-term opportunity. Where we see the long-term opportunity are in things like value, right? Small caps. Those are what typically, those two factors do the best during a recovery. And again, we went through the math of our economic growth and policy model. You see that a recovery we're improving and moving towards that recovery. So we're in this phase transition from contraction to recovery. In a contraction, momentum and quality and low volatility do really well. Low volatility hadn't done so hot, right? But it did really well from 18, right, when we peaked in the end of 18 through economically, and then through 19. Did really well through about halfway through, almost 3 quarters through 2019. Low volatility was a shining star from a factor perspective. That's exactly what works in a slowdown, right? In a slowdown, it's low vol, high quality. In a contraction, it's low vol, high quality momentum. And then in a recovery, it's small caps and value. And so we're now in this period where you have a complete about face, right? It's not as easy a transition that slowdown to contraction where you're just adding momentum into the mix. It's now a move from small caps and value, or to small caps and value from high quality and momentum. And that could be a big change. And actually you could play out a scenario where that manifests into probably a unique scenario, very similar like 2002, where you have a recovery economically, but the broad market falls because of the concentration in growth, right? Because 5 names make up 25%, right? NASDAQ 40%. So that's my long-term view, is really based on these mean reversion trades, these things that are priced for better returns than, say, large cap growth or U.S. stocks, which are priced for very, very low returns. So when we look at that, we're thinking international. First, strategic view is international over U.S. From a value perspective, long term, that makes a lot of sense. So have a capability in the portfolio to allocate to international equities, and in particular, in that's emerging market value. Second, small caps over large caps, right? That trend is pretty amazingly depressed, right, in favor of large caps. Yep. Third, value over growth. We just saw that. I think it was, I forget who I saw the chart from on Twitter, but it was value at the lowest point ever relative to growth on a rolling 10-year return basis. Think about that opportunity.
Yep.
Yeah, I mean, it's just incredible. And so those areas make up a lot of sense. And then REITs, it's commodities relative to stocks. So there's some great trades. And if we get into this recovery, and let's say we get an infrastructure bill, right, that manifests a recovery that's growth accelerating, inflation accelerating. Because right now we're in this growth still decelerating, improving but decelerating, inflation accelerating, right? Because we've had the dollar drop, so inflation's accelerated. Imagine if we go to growth accelerating, inflation accelerating, right? You had Stanley Druckenmiller on CNBC talking about inflation at 5 to 10%. What if you get that type of scenario? That is not exactly bullish on the safety trades that have worked so well, which has been the large cap growth tech high quality names. That could be super bullish for commodities, for energy, for financials, and energy and financials make up only 17% of the all country world index now. Energy and financials are undervalued. And so what happens if we get that type of recovery? I think it could mean big things for value. And I think it could mean big things for commodities. So, and REITs, I think there's a lot of opportunity in these mean reversion trades if the right environment sets up. So I would definitely be prepared to be able to allocate to those areas when the trends turn, because that's, again, ideal. And that's why I want to show both what we like long-term based on value, but where we're allocated now. Where are we overweight now? And it's a very different thing, and that's okay, right? I don't have to have any qualms about being conflicted. During phase transitions, I can be as conflicted as I'd like, right? I've got value arguing against momentum, and that's okay. And so now what we're prepared for is when momentum starts to favor these areas, then I get really excited. When those two marry up, that's I think a recipe for really attractive returns long term. So I love hearing all the value investors are dead, because I actually think that we can see a time in the near future where now momentum and value are aligned. And I think when that happens, that's going to be pretty cool.
Excellent. Clint, I appreciate you coming on this live at lunch. I love the trend report you put out at WealthShield. For viewers and listeners, to learn more about WealthShield and get access to their great content, visit wealthshield.co. That's wealthshield.co. Clint, I appreciate you coming on.
Thanks, Jay. Appreciate it.